We all know that electric vehicles, or EVs, are certainly the future. In fact, they're kind of the present now with how well Tesla has done over the years in terms of coming almost out of nowhere and being a very profitable and certainly a high demand stock. A lot of people have attention on Tesla. But the electric vehicle industry is facing some headwinds, right? We've got issues with manufacturing in China, with the COVID and all that, supply chain issues all over the world, and we have things like inflation and the cost of automobiles rising and starting to become unaffordable for many people, particularly electric vehicles. But a lot of it's just, can they get the darn things made? And then do you have like the infrastructure to support it, you know, with the charging stations also. So there's a lot of headwinds, but we know that's the way of the future. So I'm going to share with you an electric vehicle maker that was going to, I think, will surprise you, that I think is very undervalued and is maybe a good opportunity. It's something to maybe look closer at here. And it's not Tesla. Tesla's great, and we're going to actually look at Tesla real quick at some numbers with Tesla, so we can use that to compare to this other one that is undervalued, I think is very undervalued, and has a nice little bonus surprise for us as investors too. So we're going to talk about all that coming up next. Okay, I'm over here at Yahoo Finance, and let's take a look here at Tesla, just as going to be our kind of test Tesla case, right? And by the way, I have all sorts of free stuff below as far as courses, and I have, you know, paid courses are all on sale. It's really what I do. So if you're interested in really learning about investing, particularly in stock market investing, do check out the courses below. Okay, so let's take a look at Tesla here. So just a couple numbers, Tesla, things you'd learn in the courses. So one, it's price to earnings. Even though you really had a tough last year, I'm going to click on the chart. This is 1 year. You can see it's down, down, down over the last year, like the broader market is too. But it's still priced pretty high. If we look at the price relative to its earnings, or the PE ratio here, that's very high at 39.07. You know, that's very, very high. It doesn't pay a dividend or anything. Of course, it's more of a growth type stock. And so let's look at statistics here, and we're going to use this to compare to this other company. And so we'll look at a couple things real quick. So the PE ratio is actually really good at 1.13, the price relative to its potential earnings growth. We'd like to see that, you know, below 1.0 or at least near 1.0, and this is there. I mean, if you are somebody like, I want to invest in Tesla, you've got a reason to just for that. You know, and if you look at compare what it's been at, you know, it's been as high as 3.15 back in March of last year. So it's really come down, but it's still really pretty well, I would say, overvalued. It's not an undervalued pick like we're going to look at here in just a moment. You know, 5.2 on the sales, price of sales. Again, these numbers have all come way down because it was really, you know, really inflated in value. And really want to concentrate on this, that book value. 8.96 is huge. Looking at the price relative to its underlying assets, you're looking for something, if you were a value investor like a Warren Buffett, you would certainly be looking at something, that number, that price to book, less than 3.0, and ideally less than 1.0 would be amazing, because the price you're paying for the stock is actually, you know, in relation better than the underlying assets if you liquidated the company. So under 3.0, you start getting into undervalued territory. You can start looking at it as an undervalued play. This is not that, obviously, at 8.96, but it's not up at the 40s or 36.98 either. So there's some opportunity there. Also, Tesla's down 64%, even though it's had a recent comeback here early in the year, versus the S&P down 14% over the last 52 the last year. But otherwise, you know, again, doesn't pay a dividend, but it's got good operating cash flow. It's got nice margins, 21 billion of cash on hand, you know, so it's still going to be a solid company, even though it's facing these headwinds. You're just paying a lot for the stock price in relation to some of these measures. So that PEG ratio is good, all right? So let's look at the company I think that might be even more interesting, or might be interesting. And there are a lot of companies out there, but I think you should look at one to consider would be F. Like, well, what's F? You know, F is Ford. Ford? Electric vehicles? Yeah, they've made a big commitment, like a lot of traditional manufacturers, into electric vehicles. Their F-Series trucks in the United States is the best-selling vehicle of all the vehicles. They get a good margin on that. In fact, they've got a waiting list for their F-Series Lightning series, which is electric trucks, and they keep raising the prices because they have such demand for it. They can't make them fast enough. You know, that's the problem with the supply chain on it, but if they can get through that, and maybe later this year, we'll start seeing that, they might have the potential to really drive some really strong earnings. But they've got good stuff now that we can buy in low, and hopefully we'll see that pop up. Again, your portfolio is your portfolio. I'm not making a strong recommendation or anything. I'm just sharing things you might learn in my courses, for example, on how to evaluate stocks. So if we look at that Ford Motor Company, P/E ratio is 6.03. That's very attractive. It's below the S&P 500. Certainly much better than what was Tesla, like 39 or something like that. So a very attractive price to earnings ratio. But here's the surprise. I mean, it's not a surprise if you followed forward or not, but it's a nice surprise for us as investors. Then we're going to look at to see how undervalued it is to see if it's a good buy right now. But it pays a dividend. So by owning the stock, if you're looking to own the stock for long term, you're going to get 0.6 over the course of the year, 0.6 dividends per share of stock you own. And it's only $13.52 or whatever your currency equivalent is if you could buy Ford, in your country, remotely in effect. But it's only $13.52, so you can get a lot of shares and then line yourself for a lot of dividends. The key number on this is that 4.90. That's its dividend yield. So that's like if you were to use a savings account that might be at 2 or maybe 3% now with inflation going up. You get 4.90, assuming that Ford doesn't cut the dividend. It could happen. They could cut or eliminate the dividend, but companies that pay dividends don't want to do that. It's the last thing they want to do. And then they start getting some of those trucks, and those other sales, electric vehicles at high profit, at high margin coming through, particularly later in the year, then that dividend's not going to be in jeopardy. But I'm going to look at a measure to see if that dividend is in jeopardy right now. But right now, you could buy Ford, pretty low price, lock in that dividend, 4.9%, so you could really load up on some shares of that stock. Let's look at a couple other statistics here, under statistics here. And we were looking at like that PEG ratio. I said below 1.0 is good, and that Tesla was approaching it like 1.1 something. 0.36? That's extremely low. In fact, it's been extremely low. It was at 0.18 at one point. So they're not getting reflection of the price relative to its earnings and the potential earnings growth. See, this is the earnings growth. If they can deliver on that earnings growth, you're getting a good undervalued stock. If you look at price to earnings growth ratio. But look at this price to sales. I mean, it's below 1.0, all right? That's also the price you're paying relative to its sales. That's super low. And really the key number is, and this has come up lately, is the price to book. If you looked at this earlier in the year, because it's had a nice little ride up in the stock this year, it is because I think people are starting to see this undervalue aspect, is price to book of 1.20. It's not below 1.0. It's not magical, but it's definitely below 3.0. So your price relative to the underlying earnings is very attractive. You can see back in 2021 is at 2.34 and it's come down. So these are attractive entry points. Stock is down 47% over the last year. Again, S&P down 14.8. So you're buying, on its down thing. It might still go down, but again, we're hoping for that more longer term, like maybe later this year type growth. Now let's look to see if that dividend's safe. And one way to look at that is the dividend payout ratio. I'm under dividends and splits. I'm looking at its payout ratio. What percent of its earnings is it paying out in dividends? Because you pay your dividends out of your earnings or else cash in hand if you have to. You'd rather not pull on cash that you have on hand. You'd rather use that as that for other investments and pay your dividends out of your earnings. We like to see that number, certainly below 75%, below 50 is great. They're at 20%. So they're only paying 20% of their earnings out to back to us as shareholders in the form of dividends. That means they've got 80% of earnings that they can use to, staff up or build new factories or whatever they want to do with R&D, research and development. That's a nice, very safe number. And if you look at their cash flow, they've got right now, even with all the problems, all the headwinds they're facing, they've got nice cash flow of $9.21 billion on operating levered 6.72, which is a more conservative number. So the cash flow is good, and they got $31 billion of cash on hand. This would, and their current ratio, which is looking at current debt versus current assets, current liabilities. Basically, can they pay their current bills coming due? We want to see that number above 1.0, by the way, and it's solid at 1.20. But even if it wasn't, they've got a lot of cash at hand. It's positive cash flow. They'd be fine. So I would look at Ford here as an interesting thing. As far as an interesting stock, this is a daily chart, but if we look at year to date, people are recognizing this and writing up that momentum. See how this is year to date. It's gone up early in this year versus like over the last year, you can see that was up at a high around 25. We're now about 1350, right? So you can see there's some opportunity there looking over the last year. So overall, what I would say is, if you're looking for maybe a longer term holding, particularly one that pays a dividend, because remember Tesla and a lot of the new emerging EV makers don't pay dividends because they're emerging type growth stocks, but you want a nice, maybe solid stock that might not jump real high in price, or it might, because it's undervalued, but certainly can get you that rock solid dividend of 4.90 to help kind of bat inflation and stuff and just kind of lock in some nice income. Again, hopefully it won't get cut or anything like that, but all the signs are saying they can afford it. Payout ratio, cash flow, cash on hand, all that. Ford might be a company to take a peek at. You'd have to do more due diligence on it, really look closer. But right now, from just a valuation standpoint, it looks interesting to take a look at. All right. Well, I hope you like this video here. Certainly, if you like learning about investing or want to learn more about investing, I've got a lot of courses. Again, check out below, from a full 17-hour stock market course to active trading courses, all sorts of stuff. So do take a look at that, plus some free course as well at my website, Investing Education with Mr. B. All right, with that, go out and find some good stocks, and maybe you'll be buying some Ford stock, maybe you'll buy some Tesla, maybe you'll buy something else. Either way, go on and keep out investing, and I wish you all the very best of luck.